So as we talked about, I've chosen to entitle this call Enter the Bear, Exit the Bull. And that's not just me saying it. According to a July 5th, 2022 S&P Global Report, we have decidedly entered a bear market this month as higher inflation, higher interest rates, and a slowing economy pushed the S&P 500 into official bear territory. What this means for the folks on the call who may have some idea but would love some more information, that means that the S&P 500 was down 20% from its last closing high, in this case, about 6 months ago in January 2022. To give you a bit more data, the Dow Jones Industrial Average has lost about 6.1% for the month, that was in June, and is down about just over 15% for the year. So those are negatives. As we take a look at the mid cap and small caps, what you would expect to see in correlation, positive correlation, is the S&P mid cap 400 decreased just under 10% for the month, bringing its year-to-date return down over 20%. And lastly, the small cap 600 was off just under 9% in June and had a year-to-date return of under 19.53%, just under 20% for the year. So across the markets, we're seeing things in a concerning level for folks who are new to market cycles. But what I'd like to do, Ron, is I'd like to talk about how we're managing risk for PANGEA clients during the current market conditions. And specifically, what I'd like to learn about or lead with in this conversation is how are the Meridius portfolios performing? Are they down 20% like the S&P 500?
Well, welcome guys. Declan, thank you. Declan, to answer your question, and I was going to give a bit of an overview, but you actually captured everything. So the givens being inflation, the markets themselves, being very volatile. But it's a good question. The Meridius portfolios have not fallen as much as the markets. I actually took a quick snapshot of some of our holdings, just to paint a picture. For example, the TSX 60, let's use that as the closest benchmark to how we manage money, being 60 of the largest Canadian companies. Year to date, it's down about 11%. The broader index in the US is down about 20% year to date. This is as of yesterday's close. If you look at, let's say, one of our top holdings being Enbridge, year to date, Enbridge is actually up 9%. It's in all of our Canadian portfolios. The worst performing stocks that we own are the banks. TD is down 15 and Bank of Nova Scotia is down 17. So to answer your question, we're not fully exposed. We do have a 15% weighting in TD. The portfolios by and large are down, depending on when everybody got in, are down about 7 to 9% year to date. So to put it quite bluntly, the portfolios have fallen, but not as much as the broader indices.
I'm hearing, sorry, forgive me. So I'm hearing some downside protection in the Meridius portfolios, whereby if the broad market, the S&P 500 has fallen by about 20%, in the Meridius, we're looking at about a 5%, so less than half compared to the other indices that I just mentioned.
You're absolutely correct. And when you look at Canadian indices, the largest weighting on the Canadian index has always been financial services and resources. Specifically, if you have the banks, the top banks, and you've got a couple of oil names, you've got over half of the index. Our portfolio obviously did not have oil, given the volatility in oil. We do have financials. We cherry pick names that we believe, even from before what's happening right now, names that could withstand volatility and withstand what we saw, 2 years ago, that we would move into a period of higher interest rates. So, that's why we own Metro. Our overall thesis has been stay with the utilities, stay with the larger names that pay a consistent dividend, and names that can withstand, a fallout in, the consumers pulling back and retrieving from spending. We've had 20 years of growth, undoubtedly, a lot of this would have come to a bottleneck where we would have seen higher interest rates and inflation creeping up. So we still maintain a high weighting in banks and utilities and obviously food, given that things will get worse in the next couple of quarters. But the thesis is you need to eat and you need to have, lights in your house. And those are steady Eddie names, and they will produce decent returns. This market gyration that we've seen has been people trying to figure out what's happening. We not only have inflation, but we have this war in Ukraine that's set oil prices up. So oil prices, food prices all risen, and we have supply constraints coming out of Asia. So we have a whole bunch of external variables shooting up inflation, and that's created a lot of uncertainty in the markets.
I appreciate you being brave enough to make that statement, that where you use the word gyration. I of course, and you know this word well, volatility is the word that I would use to capture that sentiment. And you even were brave enough to say that over the next 2 quarters, we can expect to see some of that volatility, perhaps creating a bit more spikes on the VIX. And I'll talk about the VIX in a little while. The VIX is the Volatility Index. Now, I just want to remind participants on the call that happy to receive your questions or comments via the chat. If you want to take a look on your desktop or on your phone, there's a chat icon with a speech bubble. You can type those questions or comments into the chat and I'll read them back and moderate with Ron. We're halfway through the year, Ron, and there's been some considerable economic and financial market uncertainty. We've seen the headlines and felt the impact on our pocketbooks of rising gas prices, supply chain problems, elevated price inflation, and even labor shortages in certain industries in Canada that many other economies are really facing. That VIX, VIX, is a term that some of you on the call would likely know. The VIX is also known as the Volatility Index. It's one of the most closely watched indices on Wall Street. And the index it tends to have an inverse correlation generally with American stocks. And I'd like to quote a section from a July 5th, so yesterday, a Markets Insider article entitled "The Stock Market's Fear Gauge Needs to Spike Up Significantly Before," and I'll read this, and I hope you can receive this with the perspective that I'm sharing it. "The stock market's fear gauge needs to spike up significantly before the bear market bottoms out. The bleeding in the S&P 500 this year is unlikely to stop until there's a frenzied level of selling in the stock market." That's what the article says. And it goes on to say that of the 11 sectors on the S&P 500, 9 of it is in red, and it talked about the S&P having lost 22% over the last 6 months. The market, the article says, will not bottom until we see a large panic-induced drop. Now, the reason I was sharing this is I know that our clients are going to be reading these headlines, and I'd rather us have the opportunity to get ahead of these conversations while you and I are here to tackle them head on and really provide some context and understanding what's happening. But there's one more bit of data I'll share back in my statement before I ask my question. It's this. It says, we are well into bear market territory, but panic selling has yet to begin. Some of the data they quoted in this article is that no bear market in history has bottomed out with the VIX, without the VIX being more than 45, so 45 plus. Just for context, the VIX closed today at 27. That's what the data is showing, just shy of 27, 26.73, I think is what it was. Ron, you've professionally navigated several market cycles. You are quite familiar with navigating volatile markets. I'd like to invite your perspective on how you may perceive that this time is different and how you're planning on navigating the next 2 quarters of this type of sustained and perhaps even increased volatility. We'd love to hear from you.
Thank you, Declan. I'd like to approach to give you a scenario, first of all, and then tell you how, and answer your question if you permit me to do so. What has happened is essentially you're looking at about $1.6 trillion has been saved in the last 2 years. And that's what we have on our balance sheet. And that's a cumulative amount. Consumers, by and large, why we'll see this gyration and see that correction, to Declan's point, is there's a lot of pent-up demand. People have moved from durable goods, and durable goods being things that will last for more than 2-3 years. So they've moved from buying new cars and homes, and they're moving off to discretionary spending. We're going to see this for the next couple of months, given that you're seeing the passport line, people want to travel, people are going to spend a little bit more. That 1.6 trillion is what they're eroding. It is anticipated by this time next year, they would have eroded about 60% of their savings. That's the fat that we built up and we saved. We saved during the COVID era. Now we're faced with inflation, and inflation is now, think about what's driving it. Your prices that you're buying gasoline, that's driving it. That's number one. And that's uncertainty that we didn't create. That came from what's happening in Russia and the Ukraine. We don't control that. Two, food prices rise, and they will continue to rise, given that both and the Canadian and US front, they're looking to divert things like corn to producing ethanol. Ethanol is great for the environment by taking away corn now out of the food supply, and that's about 30% President Biden is suggesting. That will shoot food prices up higher. We now have a zero COVID policy that was still enacted in China, where we have, they've slowed down their economy dramatically, and now we have supply constraints. And this is a supply chain we always hear about. And you always hear these stories of trying to say, well, try to buy a new car. It'll take you 3 months, 4 months to get a new car. There are shortages in chips and shortages in getting parts and material, all that lovely stuff. But essentially, right now, we're in that rosy period, that period where investors don't really want to believe we're heading into a recession. Now, at Meadowbank and the Meridius portfolio, we don't follow an index. We're stock pickers. We pick the best quality stocks that will perform well, knowing what's ahead and even what we're in right now. So when you look at an index, that you have to buy certain names because it's part of the index, right? And when you're looking at certain sectors that are going to perform well in this current environment and what we're facing, you're going to see the boring names like the utilities that pay out the dividend, like an Enbridge. You're going to see the banks. They're going to get nailed because everybody's fearful that people are going to go bankrupt. But by and large, the Canadian banks wrote off $4 billion a year ago when we had this conversation in our Q4 call, and it didn't happen. People didn't go bankrupt. Canadians are better off than the Americans, which have a worse balance sheet. But we have banks. We don't have the oil and gas, given that there's a premium in the oil and gas. TD sees oil trading at about $100 at the end of next year. Nothing significant. They actually see oil prices coming back down and that volatility going away. So when we paint all of this now, and I'm sorry I've said a lot, but this is what the consumer is facing. Come, let's say September, when all of that vacation mode is gone, people then realize they're going to start tightening the purse strings. And when they start tightening the purse strings, what that means is, well, anybody that's got a fixed salary or fixed income, they have less money to spend. So they're not going to go to the movies. They might not go out to the restaurants, right? But get this, they're still going to have to buy food. They're still going to have to keep their light on. And those are the names and companies that we own. Given it's boring, but it's a necessity versus names that can be seen as discretionary. We do have a small weighting, for example, in Air Canada. Why do we have that? Given that there's so much pent-up demand, people want to travel. Air Canada has got about $4 billion on its balance sheet. The government of Canada will bail it out, right? So it's a tactical play where we'll hold it until September and then possibly dump it after September. But in a very roundabout way, I hope I've answered your question, by picking specific names rather than going off to the indices. That is how we mitigate the risk, but you will see at least another 20% drop in certain sectors. And those are the sectors that will be directly linked to the consumer pulling back on spending, because they've now realized, can you imagine if you're on a variable mortgage and your interest rates just went up 75 basis points? If you're on a fixed salary, you're going to lose your home. But most people are going to find a way to pay their mortgage. And what do? They cut back on things that they traditionally would be considered a luxury item. And we've stayed away from names like that. And those are the names, JP Morgan, Goldman Sachs, those are the names that they see that have not properly valued that other 15 to 20% correction. So to Declan's point, that's when you're going to see the mass frenzy of the sell-off, when they realize the consumer is pulling back. And as the consumer starts to pull back on their spending habits, that's when you're going to see unemployment shoot up, right? And at that point in time, as when we're positioned, given that we've got, a nice healthy position in cash, very liquid names, to look at certain buying opportunities as we pull back out, let's say Q3 or Q4 of next year.
Yeah, Ron, I appreciate the commentary and the depth that you took into expounding your perspective on it. You even went as far as talking about next year. And later on in this conversation, I'm going to bring up some forecasts into 2023 and get your commentary on it as well. But before we get there, we've had a question from someone in our audience who wants to know a bit more about some of the technology stocks. And on our last call, Ron, we talked about Apple was mentioned, for example. I want to quote from an article from Bloomberg today. Just today, they released it, entitled "Betting Against Tech is Finally a Winning Trade as Short Sellers Sit on $20 billion worth of Profit. Bearish traders reap big paper gains as the tech sector slumps." And short sellers saw $36 billion worth of losses in the prior 2 years, but now they're starting to recover from those losses. What the article says is that betting against tech has become a winning trade, with short sellers sitting on billions in paper profits as growth stocks in tech slump. The article goes on to say that a historic rout in the so-called FANG stocks, and I know you mentioned that term our last call. FANG, for everyone on the call here, FAANG, Facebook, Apple, Amazon, Netflix, and Google. The first letters of all those names represent the FANG stocks, and of course, these have delivered profits of about. Google, for example, has delivered over 19 billion in profits for investors. And even with those sort of performance numbers, the tide is turning for these previously unstoppable tech giants. For example, in the NYSE, the FANG index is down 31% and poised for its first annual decline on record, according to Bloomberg data, going back to 2014. Now, investors have been fleeing these tech growth stocks, and this is priced based on earnings and expected in the future. And these folks feel that in anticipation of further supersized interest rate hikes from the Federal Reserve will continue to worsen economic conditions, especially with these concerns about a recession. Ron, as one of our clients has asked about technology stocks, and Apple being one of those specific ones, how are your portfolio managers seeing the FANG stocks and large cap technology stocks differently, if at all, compared to what that Bloomberg opinion has stated?
Well, to answer the question, Declan, we have a very small weighting in technology. But in our US side, we do own Apple. I do like Google, and they are definitely going to have a lot more volatility than some of the names I mentioned earlier. And that comes and it stems from what I said earlier, that Apple is a lot of discretionary spending. Do you need a new iPhone, or do you need one of the other services they provide. You more than likely will hang on to it. Now, that being said, and this is something for us to note, and Declan, you and I have gone through, and most of you perhaps on this call have gone through many of market corrections. When you start seeing news reports like this, it's generally the other side telling you we've moved to value. And value is the thing where it's steady Eddie and bricks and mortar names. And and then growth is out because growth stocks are overvalued. That was the story they sang in 1999, 2000, when the market blew up. And then when the markets rebounded, all of a sudden value is not the thing. Nobody cares about, boring companies that, pay out a 4% dividend. Everyone wants a growth name. And then you start seeing Apple, Netflix, Microsoft. All of those companies, though, strategically have not become just consumer centric. They've actually changed some of their business models by offering a lot more enterprise solutions. So good quality technology names like an Apple, a Microsoft, an Alphabet, those names are not going to fail. The reason they're getting hit is because they're seeing consumer demand tapering off. And consumer demand tapering off has created that volatility. Now, odds are, being the contrarian that I am, it's an opportunity just to look at technology more carefully as the bloodbath comes in. And put it this way, Warren Buffett is the largest shareholder of Apple. He wouldn't be holding on to Apple because he thought it was going to fail. He's looking at Apple and saying, well, they're going to cut back. They've had a whole bunch of supply chain issues, moving half of their product coming in from Asia. They've fixed some of that. So Apple, in this current environment, and when I say the current environment, in the next 6 months, you're going to see it being much more volatile, right? Our weighting in Apple has been rather small. We'll stay with our traditional bricks and mortars, infrastructure type plays, but it's an opportunity. I would not be selling Apple. It's an opportunity actually, as the market corrects, if we anticipate, let's say the end of Q3 of this year, it is an opportune time to continue stacking up on our technology holdings.
So what you're saying clearly, so that I understand, is that you're seeing as the markets pull back, in this case, we heard about a 31% contraction in the NYSE FANG index. You're saying that this is potentially time to start thinking about adding to the holdings.
You're absolutely right, Declan. I mean, if you look at Apple, if you look at FANG's over half of the technology weighting in the index. So anybody that tells you, oh my God, the technology index fell by over half of the index is FANG. So that's why it would have fallen by half already. If you all remember, back in the 2000s, Nortel was 1/3 of the TSX. So when Nortel fell, everybody said, oh my God, the TSX is down. Well, the TSX is only down because Nortel got nailed. Nortel has disappeared. Now, when you're looking at technology just as one variable versus looking at the overall, yeah, FANG has some opportunities. I've stayed away from Facebook. Apple, I believe, is one of the strongest technology plays. I've stayed away from Netflix. Google is not the search engine as we know as Google, but Google is driven, it's an advertising company. And at the end of the day, they're going to see pullback with advertising budgets being cut. So Google is not a position we would be adding to. Apple's a name that most analysts have it as a hold, but it's a name that I still like.
I appreciate that. There's another name that you mentioned, and we had some discussion around in our last call, and in relation to a statement you made about discretionary spending being shifted during our current economic turmoil. The name of that company was Disney. And since last month, or at least the last quarter when we had this conversation, how's your team shifting through new sentiments about Disney with new information, new data? We've seen, you've made an incredible observation, which I think is useful to us, which is that people are starting to travel again. People are craving recreational activity, and they're looking to really spend some of that money that they didn't spend over the past 2 years. So I wondered if you've seen shifts or indicators that a company like Disney may be either in for some upside movement in the next 2 quarters, or if we're likely going to see consistently more of the same, even though folks are starting to travel up with travel mandates being relaxed, even here in Canada.
Declan and group, Disney is more of a tactical play. We will not be adding to Disney. The reasoning is it's being very cautious. Right now, it's summer vacation for a lot of North America, and Disney's got operations throughout the world as well. So parents are taking their kids out, people are traveling, Disney has cruises, all that lovely stuff, and people are going to the movies. Now, Disney at this point in time, we see it as a whole, and it, let's say September is where you'll see that rationing and that pullback, given that all of a sudden summer is over, and spending is going to be somewhat restricted. Disney traditionally is not a one-trick pony. It's not just amusement parks. Disney, I see it more, if you compare it against Netflix, it has a lot more content, and that's what Disney has positioned itself for. There is, and the Chinese and in Asia specifically have prepared for the potential another strain hitting us. COVID is not gone. Right now, with the restrictions being taken away, people feel that they've been cooped up for the last 2 years and they want to travel. So Disney will be tactical, but Disney could actually do well if there was another strain out there, given that Disney Plus has competed head on with Netflix, right? Now, we've had Disney, when we bought it in the 90s and wrote it and dumped it about 150. And we got rid of our position in Disney. I still have it as a stock that I watch at very carefully, but holding in Disney would be a function of your time horizon. If you're looking for a quick gain, it would be tactical for the next 3 months. If it's a long-term hold, you're looking at about 3 years, given that Disney will have some volatility. And most of it's going to be attributed, to your point, Declan, to a lot of discretionary spending.
I appreciate that, and part of the reason I wanted to tackle those two items is because the two stock, or the names anyways, not to be focused, is that they're generally representative of the broader market underneath them. For example, Apple being technology, representative of the technology environment at the large cap end of the spectrum, and Disney, of course, being consumer discretionary, where we see families wanting to get out there and travel, and the kids are into summertime now, so they'll want to get back to do things related to Disney cruises and so on. I do have in here a couple more statements and questions, and I'd like to ask the first one here. This is from Rob and Brenda. The comment asks, I've heard Ron's good risk mitigation strategies. Just want to make sure I got him right. Events out of our control, like the Ukraine war, have caused food prices to rise, mainly in Asia and Africa. Oil prices have been impacted. Are we saying that the impact of those external events have been non-factors for the Canadian market? Or are we saying that the Canadian market hasn't taken a big hit compared to other regions, and hence this is the reason why Meadowbank's portfolio percentage returns haven't dropped as much? So I think there's a bit more really neat understanding. It's a great question. I love that question because it shows some critical thinking here. So if you need me to requote any part of this question for you, Ron, I will, but I'll roll the microphone over to you to address the question.
Declan, and I'm sorry who asked it.
Rob and Brenda. Yeah.
Oh, Rob and Brenda. The answer is yes, actually. We're biased towards Canadian equities in general. And to put it quite bluntly, the Canadian market grew the fastest in the G7, even with all of this fallout last quarter. We're still on track for just under 3% of GDP growth. It's been revised as inflation numbers come down and they keep getting worse. But worst case scenario, the Canadian GDP numbers are looking at about a 2% growth rate. Now, that's based on most of the Canadian banks. Now, if you look at, let's say 2022, this year in Q4, in Q3, the target real GDP that they're expecting growth rate at about 3%. So Canada's withstood and has stood quite strong relative to the rest of the world. Now, we don't have any exposure into Europe. We have indirect exposure into Europe, given a lot of the names that we own are global. Emerging markets are perhaps in the weakest position, but we've stayed specifically in Canada for this reason, given that we're rather insulated. And Declan, I think you mentioned this in one of the previous calls, Canada is only about 3% of the global markets, but that 3% is a really good 3%. And given that we're global, of course, we're going to get affected, right? And if I may add, one of the questions I see popped up, consumer staples, utilities, bank stocks, they're all going to fall in the short term. Everybody's anticipating a recession, and, TD, Bank of Montreal, they're all anticipating that it's not going to be a recession. It's actually going to be close. We're positioning the portfolios as if there was a recession. And right now, temporarily, we're going to see the pullback, given that people think that everyone and the consumers are going to roll over. If they roll over, they're going to go bankrupt. If they go bankrupt, they lose their house. Banks are going to have bad loans. That's why you're seeing banks fall. Utilities, you're not going to see much of a pullback, but like Declan mentioned with the VIX, when there's a mass hysteria of selling, the good and the bad will all fall. When that smoke clears, you will see consumer staples and utilities flatline and start to rise again. And you will see banks start to rise again. Now, something to note, not all bank stocks are created equally. Some banks are more biased towards investment banking, which will dry up, and some banks are fully diversified. Our core holding is TD. We like TD given that it's exposed throughout North America, and when I say North America, Canada, and the US East Coast. And they've done a great job of integrating. The bank's got diversified revenues, and as actually one of the few Canadian institutions that actually got the US right. Most Canadian banks that have entered the US, primarily Royal, have retreated because they didn't necessarily understand the marketplace. TD's got significant fail-safes and write-downs already prepared in the event that the consumers roll over. So I'm hoping I've answered two questions at the same time, but nevertheless, there are external variables, but our portfolios performed better given that the names that we've picked could stand on their own and not necessarily influenced by outside factors. But by and large, being global, good and bad fall in uncertain times.
I appreciate that, and thank you for tackling Jackie's question. You also, you talked about consumer staples and banks, utilities. However, and maybe I misheard you earlier, but you even talked about was it a utility company that was actually up this year? Did I hear that correctly?
Yes, our holding in Enbridge is actually up this year. Enbridge pays a dividend of around 6%, slightly lower than 6%. Everybody thinks Enbridge is being a gas company, but really it's a pipeline company. And we do adhere to some of the new OSC regulations with ESG and picking names for the environmental, social, and governance. A little tidbit of information, because another client actually asked me this. It's like, Ron, why would you go to natural gas in Enbridge? Why not buy a solar name? But little do you know, in the last 10 years, Enbridge has committed over $8 billion, and they consider themselves the largest renewable energy play in Canada. And you can see this, they actually have an ESG report on their website, and the amount of money they've spent and committed into solar and wind. Now, the only reason I say that is for the folks that are looking and saying, well, are you investing in fossil fuels? We're actually investing in pipelines. And at the end of the day, you need a pipeline to ship my natural gas. And it's a pretty simple business, and it's performed well. And for those that are looking for income, it's been very consistent in paying out income. Another name, Algonquin. We own Algonquin in all the portfolios. Algonquin plays a range between $17 and $19 consistently every 2 months. You know, you buy it at 17, it crawls up back to 19, it pays out its dividend, it falls right back. But it's been consistent for the last 3-4 years. Boring business. You know, they're into water treatment and they're into power. But it's quite consistent. Algonquin's done very well as the portfolio rep.
I don't know if you heard it while you were speaking, then you talked about the 17 to 19 range. I grabbed my calculator and did some quick math because you're saying that it goes up and down in between that range regularly, right? So if we know what we're looking for, that can be a useful tool in portfolios. Jokes aside, I wanted to focus on something that's a bit of a grim prediction. And you alluded to next year in one of your earlier comments. Capital Economics has issued a grim prediction for where stocks will end in 2022, and they predict they will fall even further by the end of 2023. After a dismal first half of 2022 for stocks, investors have been hoping for a comeback, but a new report from Capital Economics throws cold water on the idea. Not only do economists there think the rest of this year will be painful, they predict the S&P 500 will end next year even lower. We don't expect U.S. equities and treasuries to fare well in the second half of this year, said Chief Market Economist John Higgins. Ron, I'd like to address the aforementioned concerns here, but I'd like to do it on this call, as I know some of our PANGEA clients are reading similar forecasts and wondering how it will affect their investments. I'd welcome your commentary on that Capital Economics report, just based on what I've shared with you and what your sentiments are in terms of how we're going to continue to insulate PANGEA clients and take positions that may mitigate the coming risk. Over to you.
Thank you, Declan. I mean, this terminology may sound cliche, but essentially we're cautiously optimistic. I'm an economist by training, and what they're saying is, and economists it's a dismal science. It's not precise, given that everything an economist says of what's going to happen doesn't necessarily happen, because you now have governments, and governments change rules. And then put it this way, and I'll answer your question, but if you looked economically at the US as a market, it's the most indebted country on this planet. Theoretically, as an accountant, it's bankrupt, right? If you look at it as an economist, it can't necessarily service its debt. They've spent and committed over $100 billion to this Ukrainian war. They're seeing that perhaps they'll help rebuild Ukraine at some point in time. But all of that, we've moved into this world where they're just printing money. And they've been doing that. There was a survey that came out sometime last year that said over half of American currency that we currently have in our pockets, or if you have in your desk drawer, has been printed in the last year. But get this, the US market hasn't collapsed. Knowing what we know, economically speaking, the market is not bankrupt. It's still the world's largest economic powerhouse. There is a lot of negativity in the market saying that, hey, we're going to roll over and the consumers are going to stop and they're all going to go bankrupt and they're all going to lose their house. It's absolutely possible. However, what that doesn't take into consideration are fiscal and monetary policies, what the government has actually put in. You know, the last spring budget, it's what made Canada not fall as much. So, you know, coming out last quarter with a 3% GDP growth, well, why didn't it fall? Well, wait a minute. They've put a lot of money to protect nominal real wages, which helped out consumers, maybe not us on this call, but they helped out the lower end of the spectrum of the income spectrum. So putting it all together now, what do we do knowing all of this? Is we're optimistic. I'm fully aware that the markets can roll over. And, there's really two angles of approaching this. Absolute safety is go to cash. We've never gone to cash, given that all of you on this line are longer term. And in the long terms, the markets always recover. And it's an always upward trend. And we will see those short-term blips. Now, are we going to see it? And I'm saying it, that we've got another year of this, given that next year when we have this conversation, we will be coming out of what we're in. And that's ceteris paribus being nothing else changing, everything else being constant right now. That there's not another war, or there's not another major crisis, or not another major outbreak. So the names that we've picked are insulated with that. Now, they're all going to, I can never tell you some of the names that we have, and Enbridge wouldn't fall tomorrow. If all of a sudden the markets fall because inflation numbers are now 8% and the government will increase interest rates, but they've said it's not going to be 75 basis points, it's going to be 100 basis points, of course Enbridge will fall, because you'll see mass hysteria and it will be punished. But people go back into the markets and realize, well, what do I want to buy? I'm going to buy a name that's giving me steady returns. So our names have been picked. I mean, in our black box, we've narrowed it down, from our universe of thousands of stocks. We've got to my disposal, I have all of the stocks on this planet, but I've got to my disposal down to about 40 names that we actually monitor. And those are the names that, we will trade if we have to trade. And that's how, having me as a discretionary manager, we'll trade it and get rid of those names. So the only name that's poised to be dumped will be Air Canada, that will more than likely unload in September. The other names are quite consistent names, and you will see some blips in them, but by and large, they will outperform other sectors.
Ron, I appreciate you mentioning what you're positioned to do even into the next quarter in terms of cycling the names in the portfolio. You've given us one example. One of the things, as I keep an eye on the time here, it's just 7:46 on my clock. We're looking to wrap up the call. So if there's anyone on the call who has any further questions or comments or thoughts they'd like to express, please use the chat and I'll moderate and share that back with Ron. And as we look to wind down, I'm a data guy. You know how my brain works. I'm great at strategy, but I also to make decisions on a strategic level, I like looking at multiple sources of data. 360s, what I prefer, rather than just siloed information. I wanted to share back some data on bear markets, because I think it's important that folks on this call are aware of the data around bear markets, so that there's some confidence in what's going on, and we really append some realism to what's happening here. The first thing I want to say is that bear markets are normal. There have been 26 bear markets in the S&P 500 index since 1928. However, there's also been 27 bull markets, and stocks have risen significantly over the long term. Just to give you some data, stocks lose on average approximately 36% on average in bear markets. By contrast, stocks gain 114% on average during a bull market. I found that data point very, very encouraging. And here's something else I wanted to share back. A bear market doesn't necessarily indicate an economic recession. And you talked about, us barely missing one. Play on words, pun. There have been 26 bear markets since 1928-29, but only 15 recessions during that time. Bear markets often go hand in hand with a slowing economy, but a declining market doesn't necessarily mean that it's a guaranteed recession. Bear markets can be painful, but overall, markets are positive a majority of the time. Here's some data. Of the 92 years of market history, bear markets have comprised only about just over 20 of those years. But put another way, stocks have been on the rise 78% of the time. The last thing I'd like to share is that bear markets tend to be short-lived. And I want you to take this data away from me. It's a data point that I think is useful as we look at what challenges that we're facing, but opportunities and how to position for them. Bear markets tend to be short-lived. The average length of a bear market is 289 days. That's only about 9.6 months, less than 10 months. And that's significantly shorter than the average length of a bear market, a bull market rather, which is 2.7 years. Okay, so it's significantly different when you look at the bear and bull markets. And we thank you all for giving this opportunity to provide some perspective, some education, some insights. I'd like to roll the microphone back to Ron to add any final thoughts, comments, or feedback for our clients as we lock off the call. Ron, over to you.
Thank you, Declan. I mean, to sum everything up, we have a lot of uncertainty. And to Declan's point, this time it'll be a little bit different because, and I'm looking at data points again, you know, in 2008, when we had the banks falling apart and the major financial crisis, we saw a massive rebound in real estate prices. And a lot of the wealth that was wiped off in the stock market was recreated in your homes being worth double what you paid for it. You know, $400,000, $500,000 homes were now worth millions of dollars. This time we're entering, and this is something for you to reassure you, this time we're entering where a lot of wealth, and most of our wealth is in our real estate assets. Our house is our biggest asset. And then we have our portfolios. This time the markets are going to attack us on both asset classes. Your homes, by and large, have all fallen 10, 15%, depending on the area you live in. Is it going to fall any further as demand tapers off? Probably, another 10%. But what's happened is demand is still there for people that can afford a home. The stock markets are being hit. And with the stock markets being hit, you're going to see good and bad all fall. That sounds very grim. However, by having us, both Meadowbank and PANGEA working together, our job is to take that away from you. And, essentially, we're optimistic with the names. There will always be bear markets, but we are stock pickers. We're going to pick the best of breed in specific stocks that will perform and weather the storm. And they've consistently done so. My mandate and how we manage your portfolios, we use something called an all times period analysis. And I'm not going to bore you, but essentially we look at historically that particular stock before it's even included in the portfolio, how it's performed month over month since its inception. And our minimum cutoff is a 5% rate of return in 3 and 5 year periods. So you will see some volatility, but historical numbers are not indicative of future performance, but essentially in the 3 and 5 year period, you should hit that 5% in our statistical modeling. And that's how we pick those names. So that's why you tend to not see technology names or tend to not see oil and gas names in our portfolio, because they can give you huge swings of great numbers and great returns, but the average client does not know when to sell. And they take it, write it all the way to the top and write it all the way back to the bottom. What we've picked is a straight line upwards. And that's how we pick our stocks. So that's my job and my role to ensure your money's protected and is growing in a consistent, predictable pattern. We will see blips, but obviously that's when the tactical side comes in of A, getting rid of a stock, or B, buying a stock because it's got great value. But that's more or less to sum it up. I hope I've reassured you that it's not just picking names, and I do not get fascinated by what I read. It's what makes economic sense. Warren Buffett put it best, there's a reason he's in Omaha, because at the end of the day, he tells you straight up, I do not want to hear the noise in New York and the rest of the world. I'm in a little town in Omaha, and I do what I know. I buy companies that have high barriers to entry and they make money. And that strategy has worked quite well. He's one of the world's richest men. So I hope I've explained all of your questions, and feel free to reach out to Declan or myself should you have more after this call.
Thanks very much. I appreciate your commentary. I mean, I'm always encouraged by the data and the statistics, to encourage folks. Um, Average length of a bear market is about 10 months. Let's call it a year and whatever the case may be. But then that's followed by up to 3 years of a bull market, which is where the big runs are. And the data says that's some significant upside based on the data. The average bull market gain is 114% during the average run compared to a contrast to 36% downside on a bear market. So that's important data. These are general numbers. Once again, this is an important thing to note. It's a general statement that's being made on those numbers, which has a different application when you consider the discretionary portfolio work that we do with Meadowbank, which actually creates a little bit more of insulation on the downside and, of course, helps with the upside when we see opportunity. Thank you, everyone, for your time on this call this evening. Ron, thank you so much for allowing us to borrow you from your family this evening. We look forward to hearing from you again in Q3, and you and I are in touch regularly. If any of you have questions, please let us know. We're reachable via email, phone, or text, and happy to help with any questions you may have. Have a good evening, everybody. Bye-bye for now.
Thank you. Take care. Bye-bye.